Hi, welcome back to Joe Blogs. In today's episode, I want to talk to you about what's happening in the Chinese economy because there is a lot going on at the moment. You don't have to be a financial expert to know that there is a trade war going on between the USA and China. Now, if you follow the channel, you'll know that China was already struggling. Its economy was already under threat because of what's happening in the property sector. In the first 25 years of this century, the economy was being boosted by the growth of the property sector. We saw huge property development companies growing up all over China. They were building out whole cities, and Chinese individuals couldn't get enough of property. People were literally throwing their whole life savings into it because it was only going in one direction, up, up, up. So you couldn't lose money. However, unfortunately, around 3 or 4 years ago, the Chinese authorities decided to pull the rug in terms of all of the debt financing that those property development companies were accessing. That led to a lot of them falling into liquidation, Evergrande being the most famous example, and the economy has really suffered because property was generating around 20 to 25% of GDP. So we've seen the economy really slowing down and struggle to hit the 5% growth target set by the Chinese authorities anyway. But what's happening right now is really starting to shake the foundations of the Chinese economy. And it was recently reported at China's largest trade fair that exporters were saying that the US markets are totally frozen. They can't send any products at all because nobody really knows what's going on with regards to the 145% tariff that's been introduced by Donald Trump. And for many of these businesses, the USA was the biggest market by a country mile. Around 70 or 80% of sales for a lot of electronics businesses were going directly to the USA. And not surprisingly, the Chinese authorities are now urging Chinese exporters to diversify their markets to find new sales channels. But that's easier said than done because if you look at the spread of markets from China's perspective, you can see that the United States is a complete outlier here. It represents around 15% of all of China's exports. And when you look at the rest of the world, no other market makes up more than 5%, and the vast majority equate to less than 1%. So logistically, it's going to be very difficult for these Chinese businesses to be able to divert all of their sales elsewhere because, firstly, the other markets aren't as large. So they need to find, if you've got 1% markets, you need to find 15 of those to replace the loss of the US market. But also, from a logistical point of view, it's really difficult to be able to do this in a short space of time because many of these goods are sent in containers on large ships that take 6 to 8 to 12 weeks to get to their destination. So obviously there were lots of ships that were currently being loaded up. Some of the ships were already in transport, and to send all of that cargo somewhere else means you're going to have to either bring it back or redivert that ship, and none of that is very easy to achieve. Now, before we go on any further today, I want to talk to you about NordVPN, who I've partnered with for today's video, and who are offering Joe Blogs viewers an exclusive 4 months extra on a 2-year plan. Unfortunately, cybercrime is becoming a more and more common occurrence. And it's not just you and I who are being targeted. It was recently reported that multinational telecommunications giant BT Group had to shut down some of its servers following a ransomware attack by a gang called Black Basta. So it's never been more important to protect yourself online. And NordVPN offers a feature called Threat Protection that blocks access to websites known to host malware, including ransomware. So NordVPN is fantastic for protecting you every time you go online to make sure that nobody's hacking your passwords and can't steal your identity or any money from you. But it's also fantastic for opening up a world of entertainment because you can access movies and TV shows and sports events in areas that's not available to you normally. All you need to do is change your location and access all of that entertainment and information. And the fantastic news is that NordVPN is offering Joe Blogs viewers an exclusive 4 months extra on a 2-year plan, which you can access by going to nordvpn.com
Joe Blogs or clicking in the link in the description below. And the great news is that they're offering a 30-day money-back guarantee.
Now, in terms of discussing the potential impact of the new tariffs on Chinese exports, I thought it was worth looking at what's been happening with electric vehicles, because Chinese electric vehicles have been in focus for the last couple of years because they've been selling at significantly cheaper rates than all of the locally manufactured electric cars. Many countries believe that the Chinese authorities are subsidizing these large Chinese electric vehicle companies, allowing them to have grants and access to free land and basically not paying any taxes to be able to sell their vehicles at significantly lower prices than overseas manufactured cars. And so they were launching investigations, and we've seen a variety of different countries imposing large tariffs against the import of electric vehicles coming from China. So if you look at this chart, you can see that the United States under Joe Biden announced that it was imposing a tariff of 100%, so basically doubling the price of those vehicles when they're sold in the USA. The European Union, after its lengthy investigation, whereby it asked all of the Chinese car manufacturers to give it data so that it could analyse exactly all of its costs, it's brought in a sliding scale of up to 38%, depending on what the brand is. But on top of that, there are also some other duties. So you can see that the actual tariff that's imposed when these vehicles are sold in the European Union is closer to 50%. India has imposed a tariff of 100%, similar to the USA, and that's to protect the Indian electric vehicle manufacturers. That's a relatively new market, but India wants to develop that market, so it doesn't want China coming in and wiping out all of its sales. Brazil has imposed a tariff of 35%, Turkey 40%, Indonesia 50%, Argentina 35%, and Mexico also has a sliding scale of between 20 and 35%. So you can see that these are significant amounts, and these markets represent some of the biggest markets that Chinese electric vehicles were targeting. Now, in terms of looking at the impact of those tariffs on the sale of electric cars coming out of China, this chart shows the volume of sales over the past 12 months. And the scale on the right-hand side here doesn't start at zero. It starts at 80,000 and goes up to 180,000. And you can see that back in February 24, China was exporting around 110,000 vehicles. That figure increased in March and April up to a high of 170,000. Now, as the tariffs started to kick in all across the world, that impacted on the volume of Chinese electric cars. And you can see that the volumes started to fall. They then increased again from July to October as many countries started to import large amounts ahead of these tariffs actually coming into force. We didn't get any data in November. In December, the sales were over 115,000. In January, they spiked at just under 170,000. However, in February, we have seen a complete crash in the total volume of electric cars being sent out of China. It fell to 86,000, which, as you can see, is the lowest out of all of the months on this chart. And if we expand the scale to show the last 3 years, you can see that the sales in February were actually the lowest since September 2022. And when you think this is a growing market, more and more electric vehicles are being sold every single month around the world. Lots of countries are introducing legislation to try to force consumers to buy electric vehicles because they're seen to be cleaner than the old style cars. Then this isn't going in the right direction from China's point of view. And if you look at the shape of this chart, you can see that between the middle of 2022 and the end of 2024, there was a sharp increase in the total volume. It was rising almost every single month. During 2024, sales have plateaued, so it's gone into a relatively static phase. And then, as you can see, the most recent data shows that it's coming down sharply. And of course, this is before Donald Trump's tariffs take effect. This is only data up until February. So if you extrapolate forward for the next 6 months, if those tariffs remain in place, it's likely that we will see a complete crash in terms of the volume of electric cars being sold from China overseas. And this really tells us that the tariffs could have a devastating impact on China's total exports. Now, in terms of looking at the dynamic between price and volume, This chart shows what's been happening over the past 3 years for Chinese exports. So let's have a look at the red line first, which shows the average sales price for Chinese exports. What this shows is that back in 2022, when actually the COVID-19 restrictions were still in place in China, so it was limited in terms of what it could actually produce, it reduced its volumes, that actually had a beneficial impact on the price. And you can see here that the year-on-year movement, which is an index, the scale on the left-hand side goes from 80 at the bottom to 120 at the top, and the dotted line across the middle is the 100 index. So basically, if you were selling today at the same price as this time last year, that would represent a score of 100. But you can see that the red line in 2022 was significantly above 100, and in fact, it was somewhere in the region of 115. So that means that year on year, Chinese manufacturers were achieving a sales price of 15% up against the previous period. Now, if we look at the vertical dotted line, which represents when all of the COVID-19 restrictions were removed in China, and this was around 12 months later than the rest of the world. That meant that all of the factories then became fully operational, so they could produce the maximum amount of output. So the volumes started to increase, and simple economics tells us that when volumes increase and if there isn't a representative demand increase, then we will see sales prices falling. And that's exactly what happened. You can see that the red line after the dotted line goes down significantly and actually crosses the 100 barrier. And in fact, sales prices by the end of 2023 were down by around 10%. Now, at the start of 2024, prices started to increase as we saw volumes coming down. However, they haven't got back to that 100 level. So year on year, sales prices are down for Chinese businesses. And that represents seriously bad news, particularly if your costs are going up. And we'll talk about producer prices in a moment in more detail. But if we now have a look at what's been happening with the volume of sales, which is shown by the blue line, you can see that back in 2022, the volumes were at or around that 100 level. There was a bit higher and a bit lower. However, as soon as the Chinese removed the COVID-19 pandemic restrictions in start of 2023, you can see that there was a huge surge in the volume of exports. And this was because all those factories were open and so they needed places to sell them. So this has been referred to as dumping by lots of nations around the world. They were saying that China was just basically forcing all of these products onto everybody. But you can see that in 2023, there was a massive increase in the volume of sales. And by the end of 23, the year-on-year movement was up by more than 20%. Now, during 2024, we've seen the volume of sales continuing to increase, and by the end of the year, it was up by around 15%. But if you take a step back, the story of this chart is that over the past 3 years, the volume of Chinese exports has risen significantly, but the price has fallen, and that represents serious problems for Chinese manufacturers. This chart shows the movement in the producer price index in China over the past 12 months. And the producer price index is also referred to as the factory gate price. So basically, the price of a product as it's leaving a factory in China. And the first thing to note about this chart is that the scale on the right-hand side starts at 0% at the top and goes down to -3% at the bottom. So the obvious thing here is that in every single one of the last 12 months, producer prices in China have been falling. And the most recent data for March 25 shows that year-on-year producer prices are down by 2.5%, which is actually the biggest fall since November 24. And if we widen the scale of this chart to show what's been happening over the past 3 years, you can see that producer prices have been falling in every single month since September 2022, which is 30 consecutive months. And that represents a serious problem because if your costs are going up, if you're paying your people more, if your raw materials are costing more, if you're having to pay more for your rent and rates and power, then you can't pass on any of those costs because the sales price is going down. So Chinese businesses have been absorbing these higher costs, and that means that they're making less profit, and in many situations they're making losses. And it's estimated that more than 50% of Chinese businesses are currently booking losses. And that's obviously unsustainable because at some point you become bankrupt, illiquid. And if we look at what's happening in terms of the month-on-month movement, you can see that over the past 12 months, there have only been 2 months where we've seen an increase in producer prices. And over the past 4 months, it's been getting worse. And the most recent data for March 25 shows that month on month, producer prices fell by 0.4%. So it doesn't look like there's any end in sight in terms of the problems for Chinese businesses. Now, we've talked about the export markets, but obviously the other market that Chinese companies can sell into is China itself. And this chart shows the movement in the official rate of inflation over the past 12 months. And what this shows is that in March 25, year on year prices fell by 0.1%. And that's off the back of a 0.7% fall in February. So producers are not having any luck in China at the moment. They can't get their prices up overseas, and that's going to be probably an even bigger problem with these new tariffs. But they're also seeing falling prices in China itself. So there's no respite for any of these companies. And if this continues, it's going to be really problematic. And this chart shows the month-on-month movement in inflation. And as you can see, over the past couple of months, things have been getting worse. In February, the month-on-month movement was a fall of 0.2%, and in March, that has doubled to 0.4%. And if we look at this chart, which shows the year-on-year movement in the value of imports, and the reason why import values are important is because for a lot of manufacturing businesses, they're importing raw materials. So if imports are increasing, then we know that companies are gearing up. They're building lots of things that they're going to export. So that means lots of sales down the line. And what we can see here is that the year-on-year movement in March was a fall of 4.6%. And that comes off the back of a fall of 8.5% in February. So what that tells us is that Chinese companies are not gearing up, they're not buying in lots of raw materials, and so it's likely that the situation is going to get worse in terms of the volume that they're producing. And then on top of that, we've also got the tariffs, which are obviously going to make things more expensive and potentially mean that they will sell even less. So what's the summary and conclusion today? Well, I wanted to post this video because we've been following what's been going on in China over the past few years. And what we've talked about is the fact that the Chinese economy has been struggling as a result of the fact that the property sector has imploded. It was really underpinning the growth of the economy over the past 25 years. And because it's now gone into serious decline, we're struggling to be able to get to that 5% growth target. So China was already under pressure. However, what's happened over the course of the past few weeks has dealt it a devastating blow. Its biggest single export market, the USA, has basically slapped a 145% tariff on all Chinese imports, and that's going to be absolutely devastating for a lot of Chinese businesses. But what we've looked at in today's video is what's going on right now, and it looked like things were already in a serious situation because we've seen that producer prices have fallen again for the 30th consecutive month. So that means that Chinese businesses aren't able to pass on any of their cost increases, so they're reducing the amount of profit that those companies were making. In addition to that, we've also seen that import volumes have fallen again. So these companies aren't able to actually sell their way out of the problem. They're buying in less raw materials, so they're likely to have less in terms of product to sell. However, what we also saw in terms of the case study on electric vehicles is that if tariffs are applied to Chinese exports, it has a devastating impact on the volume of sales and therefore the revenue and the profitability for those companies. So we know that tariffs work in terms of reducing the amount of sales from certain countries. And what we've seen in today's video is that those businesses are going to really struggle because electric vehicle companies are already suffering. They've seen a huge fall in demand for Chinese electric vehicles overseas. And it's likely that as we go forward, that's going to happen to more and more Chinese products because these tariffs are going to make them more expensive. And simple economics tells us that when the price of a product goes up, demand for it usually falls. And so you'll make less sales and therefore less revenue. So the overall summary of today's video is that China was already on shaky ground at the start of 2025. We've seen from the data today that that is continuing. We've seen that imports are going down. we've seen that inflation has now gone into deflation. So the actual sales price across the board in China is now falling for all manufacturers. That represents a serious problem because it means you can't pass on any of your cost increases. And so Chinese businesses are now absorbing all their additional costs. That's likely to get significantly worse given the tariffs that have been applied in the USA, the biggest single market by a long way for Chinese businesses. And all of this is a recipe for disaster. It's a perfect storm, and I think it's very unlikely that China is going to achieve its 5% growth target for 2025, given where we are right now. So hopefully you've enjoyed today's video, you found it useful, informative, and thought-provoking. If you've liked what I've said, then please give me a thumbs up. Thank you for watching this video all the way through to the end. Thank you so much to everyone that's supporting the channel. If you bought me a coffee or sent me a YouTube super thanks, thank you for that. I really, really appreciate it. And if you're a long-term supporter, either through YouTube membership or Patreon or Buy Me a Coffee membership, thank you for that support. Really helps to keep me motivated. And here's something to put a smile on your face.